So you want to do a cover call in Delta Airlines, but you don't have $5,000 to buy the stock? Here's a trade that provides a similar position, but uses far less capital to do so. I made this exact trade for a profit in this video. Let's hop into the platform and walk through it. I'm looking at Delta today. Delta Airlines trading at 49.30 here. We've got an IV rank of 37 and change here. The stock has kind of chopped around the 50-ish handle here. We've traded it a couple times. It's a very liquid underlying. Does have earnings coming up, which is something that we have to consider. But I think this is an interesting stock to do a synthetic cover call. And what a synthetic cover call is just an in-the-money short put. So when you sell a put in the money, it incorporates both the intrinsic value of stock with the out-of-the-money call premium. And so when you look at Delta, I mean, you can go to any expiration you like. Let's go to August just to give us a little bit more duration here. If you were to sell the 52.5 put, this put is synthetically long 100 shares of stock and short the 52.5 call, this 38 delta call. So you have 60 deltas-ish to the upside. When you look at the analysis mode, you'll see that this looks exactly like a covered call risk profile. So the benefit to this is that you're doing this for far less buying power than you would if you were buying the stock outright. And we can show that here in a second. So when you have this risk profile, your profits are capped to the upside. You have a buffer to the downside because you're selling $2 or $3 in extrinsic value here. You can see our extrinsic value at $1.87. So you have that $1.87 of buffer to the downside. If we were to buy stock and sell the 52.5 call, you can see the risk profile is the exact same. We cap out at 52.5 is where our intrinsic value caps out. Our break even is down at 47 and change. You can see though that the buying power here is $2,200 versus the in the money short put that only uses about $900 in buying power. So it's a much more capital efficient way to be long the stock and with a cover call here. The only caveat is that you miss out on any potential dividends here that that may be in play, given that you don't own the stock outright. But that is not an issue here. With the stock, the 19-cent dividend coming at the end of July is not something that I'm too worried about. So we're going to go ahead and do a cover call here. I think we could stick to, if we wanted to go to like the 50 strike, let's look at these July options. So I think because we have earnings coming up July 10th, I want to get that kind of instant pain or instant gain. So I'm going to go to the July monthly expiration. It gives you a little bit of extra time to be right, just in case the stock does fall here after earnings here on July 10th. So you'll have another week or so to manage this position. I'm going to go to, let's see where the open interest and volume is. So one of the things that you'll obviously see is that the strikes that are open for the longest period of time, the 50, these are 2.5 point wide strikes. These will have the most open interest and volume just because they are open the longest. I'm going to go to the 50 strike put. This is just slightly in the money, about 70 cents in the money. So it's going to be a lot of extrinsic value here, mostly extrinsic value, only 70 cents of intrinsic value. But it's right at the money. Gives you that cover call type risk profile. $900 in buying power, so a lot of buying power relief relative to the stock. So let's see if we get filled here at 271. And we're in 271 on our short put in Delta Airlines. Stick around because we're going to have to manage this trade going forward. One trade that we had on was in Delta Airlines. This was a synthetic covered call. So we sold this at 271. It's the 50 strike put, which is now out of the money. We sold this as a in the money put. So we did this when the stock was trading at 49.25. The stock is now trading at 51.44. So it's gone up about $2 here. You can see the implied volatility has sort of increase. You have earnings coming in this week. The duration is also only 11 days, so volatility tends to be higher. So you haven't really been helped or hurt by volatility. But a lot of this has really come from time decay, right? So this option has decayed. We got this move, this directional move higher, which is exactly what we wanted. When we look at the analysis mode, you can see when we pull up our trade here, we had this synthetic cover call. The stock was trading somewhere around here. We've since rallied, and as time passes, we'll actually make more on this trade. Again, though, we do have earnings coming up. So on the overview tab, if you look at the quote details here on the right side panel, you can see earnings are coming up on the 10th, which is the middle of this week, right before expiration. And this little bell icon, you'll see the arrow pointing to the left means that it's before the market opens, whereas pointing to the right would be after the bell. This one is before the bell. And so this has earnings this week. It's been a nice trade. We're up about $100 on it. It's time to go on this trade. It worked out exactly as we wanted it to. If you remember, one of the key things with in-the-money puts as synthetic cover calls is that you use significantly less buying power than you would buying the stock. Stock is $50 and change. Would use $5,000 in a cash secured account. In a margin account, you get a 50% buying power reduction, so it would only use like $2,500 in buying power or $2,000 in buying power. This is still significantly less than that, given that you are using options, so you get a little bit of extra leverage there. So we're going to go ahead and close out of this in-the-money put, this that is now out of the money. Let's see if we can get 168 and we'll move from there. There we go, 168, closing out of this synthetic cover call for $105 profit. Nice little trade for us. Good little win for us on the Johnny portfolio.